Welcome to Leaders Talks, where we talk to members of ETF.com's top 100 leaders list. I'm Kristin Myers, editor-in-chief of ETF.com, and I'm here with Darren March, co-founder and president of March Lutz Wealth Advisors. Darren, thanks so much for joining us.
Thanks for having me. Appreciate it.
So I want to first start with why you decided to even become a wealth advisor. Was that something that you wanted to do from the time you were a little boy, or was there a different journey that you took to get to your current?
Close. I would say back in high school, I think I was pretty sure that this is what I wanted to do. I had been accepted to college. I knew I was going to do something business related. Wasn't sure exactly. I had an economics class my senior year, and we ended up learning quite a bit about the market. And at the end of the year, we had a contest, a project, stock picking project, where you would partner up with another student in the class. You picked a portfolio, you tracked it for 8 weeks or so. And I remember just really enjoying it. It was my first experience really with the market. My parents weren't investors, and I really just remember enjoying it. This was at a time, by the way, when the internet wasn't really a thing yet. It was like mid to late 90s. So in order to check our progress,
newspaper and at the closing prices in the paper.
well, right. So like we had to wait till the next day. The teacher would bring in the Wall Street Journal, and we would check our progress. So the school did not have internet, so we couldn't check it real time. But lucky for me, we had dial-up internet at home. So I would rush home every day after school. I would check the portfolio, see if there's any changes we needed to make. And I just remember it being a lot of fun. And I thought to myself, if this could be a career, I would really want that as a career. So I graduated from Penn State with a finance degree. I moved back home to my hometown of Pottsville, Pennsylvania, small town in northeastern PA. I got a job at a local bank as an entry-level financial advisor. Zero experience, zero training program, by the way. The training program was my boss gave me books and said, study, get licensed, and off you go. So it was a pretty fun way to, I think, introduce myself to the industry. But it worked out. I stuck that out for a couple of years. Ended up going independent in 2006 to build my own book and my own business. Along the way, met up with my co-founder, Tom Lutz. And like 16 years later, here we are.
So the reason that you're a member, or one of the reasons, not the only one, but one of the reasons that, we picked you to be a top 100 member of our leaders list and a member of the leaders community is because you use ETFs so much in your client portfolios. Why ETFs? What do you like about them so much, and particularly for use in client portfolios?
Yeah. The bulk of our business are discretionary, actively managed portfolios. And the models that we use in those portfolios, myself and Tom Lutz, we put those together ourselves in-house. We don't farm that out third party. So using ETFs is a no-brainer for us. It's just I would say probably for the same reason that the other 99 advisors on your list would give you. The transparency, the tax efficiency, the cost structure of the ETF. It just makes it perfect to be able to build a portfolio and properly manage that portfolio in someone's account. It's just the other reason we like it is just the broad spectrum of offerings that are out there, and it's ever expanding. Probably weekly, you see new offerings out there that cover every single aspect of the market, from your broad-based, total market all the way down to a specific part of a sector. You could find something. So I think it makes our job as advisors easier. We could be really tactical with our portfolio construction. We can make changes pretty easily when we need to. So we love using ETFs. As I said, it's not 100% of our model, only because we have a bit of a cash element in there, but it's pretty close. And I can't see a scenario where we would ever move away from using them.
Question for you. What is your biggest or funniest or weirdest financial mistake, we'll call it, that you've ever made?
Okay. GameStop. Maybe I should end it there. No, so funny story. So no, by the way, full disclosure, no one is going to feel sorry for me after this story, but there's a bit of regret in here, I promise. So we bought GameStop. I have two boys. They're 14 and 18 now, but when they were younger, I had opened some investment accounts for them, and we would typically buy stocks in there that, companies they know. And 8-year-olds know video games. So
Mhm.
now I'm talking 2017, 2018 timeframe. So we bought GameStop for them. And it was essentially a dead stock. We bought it sort of for the educational purpose, like the Warren Buffett thing, buy what you know. So it sat in their accounts. We might have paid $4 a share for it. It sat in there. Fast forward to early 2021. I walk into the office. I bring up our account for whatever reason. I was checking on something, and I saw my kids' accounts had popped, and I didn't know why. I could not figure it out. So I looked in there. I see GameStop is trading, in the $30 range. So here's a $5 stock, $4 stock trading at $30. So kind of figure out, the headlines start to hit about the meme stock era was starting. Um, well, it goes to about 45, and I did what any prudent financial advisor would do when a $4 stock is trading at $45.
No.
But now I sold some off the top, right? Ring the register. Uh, so I didn't sell all of it. So what happens over the next month? I think it reached a high of about 480. And I wish I could sit here and tell you that I waited until it hit 480. Uh,
College fund that could have been, that's a whole
yes,
conversation
yes.
that could have been funded.
So I didn't. I will say, and this is why I said no one is going to feel sorry for me. Uh, I think we got out of it at about 80. The rest of it, that was on the way up, not on the way down. So yeah, there's a bit of regret, and that's one I think I will always think about, for
Well,
sure.
Darren, you're not alone. I think every investor has one of those stories on either the upside or the downside. They either got out too early or got out too late.
Definitely.
That's part of, I don't want to call it a game because investing is not necessarily a game, but that's part of it. Part of the, and you live and you learn.
Right, right.
All of that stuff. So I can
Well,
totally understand and feel the regret though.
it is, yeah. Well, it's funny too. The other thing about ETFs that I like is that there isn't a personal emotional connection for the most part from clients to ETFs. So that's like one less roadblock as advisors that we have, and even as investors that we have. I mean, I joke with clients and I say, you're not going to the country club or to the coffee shop and bragging about the dividend growth ETF you have. It just doesn't happen. And that's good for us because we're able to make the proper financial decisions in a lot of cases for clients, and we don't get that emotional pushback sometimes you do with an individual stock where you get attached to it.
You have to be unemotional about your investment
Absolutely.
and then
Yeah.
sometimes keep it boring and keep it.
Keep it boring. It's good.
All right, Darren March, co-founder and president of March Lutz Wealth Advisors. Thanks so much for joining us.
Thanks for having me.